Our state of mind can affect our financial decisions more than we think. People do not always make choices in a rational manner, and economics is no exception. In this video, we will delve into the relationship between psychology and economics, what financial psychology is all about, and above all, what we can do to assertively use our finances without becoming our economy's worst enemy. But before we begin, make sure to hit that like button. Also subscribe to my channel. 1. Fear and anxiety. Fear and anxiety are powerful emotions that can significantly impact financial decision-making. When individuals experience fear about their financial future or the possibility of losing money, they may become overly cautious and avoid taking necessary risks. This avoidance can hinder opportunities for growth and prevent them from making informed investment choices. Anxiety, on the other hand, can lead to a constant state of worry and uncertainty, making it difficult to stick to a well-thought-out financial plan. People who are anxious about their finances may make impulsive decisions to alleviate their immediate discomfort, which can result in poor choices that are not aligned with their long-term goals. 2. Greed and overconfidence. Greed and overconfidence are psychological factors that can exert a detrimental influence on financial decisions. Greed, fueled by an insatiable desire for more wealth, can lead individuals to chase high-risk, high-reward investments without adequately considering potential downsides. This can result in taking on excessive risks that could lead to substantial losses, as the pursuit of quick gains may overshadow prudent, long-term financial planning. Overconfidence, on the other hand, stems from an inflated belief in one's own abilities to predict market movements or outperform the average investor. This overestimation of one's skills can lead to a false sense of security and an inclination to make risky bets. 3. Loss aversion. Loss aversion is a cognitive bias that has a profound impact on financial decision-making. It refers to the tendency for individuals to feel the pain of losses more strongly than the pleasure of gains, leading them to make irrational choices to avoid losses. This bias can result in holding on to losing investments for too long, in the hope that they will eventually recover, even when evidence suggests otherwise. This behavior can prevent individuals from reallocating their resources to more promising opportunities, hindering their overall financial growth. Loss aversion can also lead to a reluctance to take calculated risks, as the fear of potential losses can overshadow the potential for gains. 4. Herd mentality. Herd mentality, also known as the herd instinct or groupthink, is a psychological phenomenon where individuals tend to conform to the actions or opinions of a larger group. In the context of finance, this can lead to individuals making investment decisions based on the collective behavior of others, rather than conducting independent research or analysis. Herd mentality can amplify market trends, causing asset bubbles or crashes as a result of widespread, uncritical adoption of certain investment strategies. Herd mentality often arises from a fear of missing out, FOMO, on potential gains, or a desire to avoid being singled out if a particular investment goes wrong. 5. Confirmation bias. Confirmation bias is a cognitive bias that influences financial decision-making by causing individuals to seek, interpret, and remember information in a way that confirms their pre-existing beliefs or opinions. In the context of finance, this bias can lead people to actively seek out information that supports their investment decisions while ignoring or dismissing data that contradicts their views. This can result in a skewed understanding of market trends and potential risks, ultimately leading to suboptimal financial choices. 6. Anchoring. Anchoring is a cognitive bias that influences financial decisions by causing individuals to rely too heavily on the first piece of information they encounter when making judgments or estimations. In the realm of finance, anchoring can lead investors to fixate on a specific reference point, such as an initial purchase price, and make subsequent decisions based on this anchor, even if new information suggests a different course of action. This bias can prevent individuals from accurately assessing the current value or potential risks of an investment, leading to suboptimal choices. Anchoring can be particularly detrimental during negotiations or when setting prices. For instance, an investor might hold on to a stock because they are anchored to the price at which they initially purchased it, even if the stock's fundamentals have deteriorated. 7. Regret. Regret, in the context of financial decision-making, is an emotional response to a perceived poor choice or missed opportunity. This powerful emotion can significantly impact how individuals approach future financial decisions. When experiencing regret, individuals may become more cautious or hesitant, fearing the possibility of making another mistake. This can lead to decision paralysis, where individuals avoid taking necessary risks or fail to capitalize on opportunities due to the fear of regretting their choices later on. 8. Overreaction to news. Overreaction to news is a behavioral tendency wherein individuals respond to new information, especially sensational or dramatic news, by making swift and often exaggerated changes to their financial decisions. This can manifest as hastily buying or selling investments in response to headlines or events without thoroughly assessing the broader context. Overreacting to news can lead to impulsive and emotionally driven choices that may not align with a well-considered investment strategy. Overreacting to news can be particularly problematic in the fast-paced world of finance, as markets are influenced by a myriad of factors beyond immediate headlines. This behavior can lead to heightened volatility, as the collective actions of overreacting investors can amplify market fluctuations. 9. Instant gratification. Instant gratification refers to the tendency of individuals to seek immediate rewards and pleasures rather than pursuing longer-term, more substantial goals. In the realm of finance, this behavioral trait can lead to impulsive spending, borrowing, or investment decisions driven by the desire for immediate satisfaction rather than careful consideration of future consequences. Instant gratification can undermine prudent financial planning by prioritizing short-term enjoyment over long-term financial security. This behavior can manifest in various ways, such as overspending on luxury items, accumulating high-interest debt, or chasing speculative investments with the hope of quick returns. 10. Emotional spending. Emotional spending is a pattern of consumer behavior where individuals make purchases driven by their emotions, often in response to stress, boredom, sadness, or other emotional triggers. This behavior is characterized by buying items to alleviate negative feelings or to experience a temporary boost in mood. Emotional spending can lead to impulsive purchases, accumulation of unnecessary debt, and a lack of mindful consideration for one's long-term financial well-being. People may engage in emotional spending as a way to cope with challenging emotions or seek a sense of momentary pleasure. If you found this video enlightening, remember to show your appreciation by giving it a thumbs up, subscribing to our channel for more thought-provoking content, and sharing your thoughts in the comments below.